Welcome back. My name is Chris Sachinelli. I get to build, buy, and sell simple profit businesses every single day. And today we're going to be talking about metrics that matter for your business. If you stick with us all the way to the end of this video, you can have access to a template that we've built. We use this with our advisory clients over at Simple Profits, and it will go through all of the different metrics that we're going to discuss today. There's 15 of them. And there's also a key so that you can, pretty much reference it pretty fast, put it to use, and then actually keep track of it so that you can measure what matters in terms of the metrics that matter inside of your business. Inside the community over at Bootstrapper Capital, we're hosting a Teach, Train, Equipped, where we actually share our own business data, and a lot of the concepts that we cover today, we build in public and we'll share our own information. If you want to join that, you could find that over at community.bootstrapper.capital. It's the Bootstrapper community. It's where we build better together. And if you want to get access to the template at the end of this video, you can go over to shop.bootstrapper.capital and you can use our promo code that's linked in the description to be able to get access for you to be able to download and get access to that template. So jumping on into it today, metrics that matter. Ultimately, you need to be able to focus, right? Because strategy equals focus, and make good timely decisions inside of your business. And the material that we're going to cover today are different metrics that you can pay attention to. You don't need to be a math genius to be able to figure these things out. We make it super simple where the formulas are going to be there for you to just follow, but the work's on you. You need to be able to know what it is, why it's important, and then ultimately how to use it, right? So that you can adopt it inside your business. That's what we're going to cover today. And then you can, take that template and apply it to your day-to-day. The first thing we're going to get into is gross profit. The gross profit is ultimately the amount of revenue that you're generating that exceeds the cost of goods sold, right? So when we sell things, we price it, we have a price, and then we have a cost to be able to deliver that thing we sold. If you subtract the price minus the cost, that's going to be your gross profit. And, we believe in building simple, profitable businesses, profit-led businesses, right? So we focus heavily on this gross profit number, and ultimately what becomes gross profit margins to be able to optimize the profitability of your business over time. So it's your gross profit equals your total revenue minus your cost of goods sold. And it's essentially telling you how efficient your company is at producing the products or solutions in which you sell, right? Gross profit oftentimes is confused to a certain extent, but definitely impacted by cash flows, right? So cash flow is different than gross profit because sometimes, we'll sell things and we don't necessarily collect the cash today, right? We're not necessarily getting paid today. Cash flow is the actual tracking of the inflows of money versus the outflows of money, right? Again, with gross profit, we may not collect the money in real time, and we also may not pay out the cost of goods sold in real time, right? So we need to know what our gross profit is, but then we need to manage our cash flows because the cash flow is ultimately the net amount of cash or cash equivalents, right, that is being transferred in and out of your business at any given time. So if you have positive cash flows, it is an indicator that things are healthy. You're able to settle your debts, pay your bills, make sure you're meeting payroll, right? All of the things that are required to be able to continually run a profitable or profit-led business, right? Speaking of run, you then have your run rate. And your run rate is, if you were to forecast forward, how much revenue your business is going to be generating. And you could say revenue, you could forecast a run rate based off of gross profit, right? So you can take your current period. In this example on the slide, we use a quarter, right? So we looked at the amount of revenue generated in Q1, right? So the first quarter of the fiscal year, and it was $1 million. In order to forecast our run rate or, a projection of our performance, what we did was take that 1 million and we multiplied it by 4 because there's 4 quarters in a year. You could do the same thing with a monthly number. So you could take your monthly revenue or your monthly gross profit, right? Or your monthly expenses. This is a way for you to forecast into the future in a very simple way, right? Keep it simple type of way. In terms of lifetime gross profit, what you're trying to figure out is forecasting, right? So similar to run rate where we're forecasting into the future, we're trying to forecast how much gross profit we're going to be receiving from a customer that we've been able to earn inside of our business, right? So close and convert a customer. How long is that customer going to stay with us? And how much gross profit is going to be generated from that relationship over a period of time. This is extremely important because we want to know how much our customers are worth. So when we get into our sales metrics, which we're about to come up on shortly, we can factor in, okay, if it's going to cost us a certain amount to acquire, how much is that customer going to be worth in the short term? And then also over the lifetime of that customer. And that's just the average revenue per customer times the gross profit margin times the average customer lifetime, right? How long are they going to stay with us? Very important number to know, but it takes a lot of data to be able to figure it out. And as you continue to run and operate, each of these metrics, you're going to be able to hone in a little bit better, a little bit more efficient, a little bit more effective, a little bit more accurate, right? The next cost comes to what I was just referring to on the acquisition side, on the sales side. So we're figuring out our customer acquisition cost. And the customer acquisition cost is the total cost that you're incurring as a business to acquire a new customer, right? So again, the lifetime gross profit, that's how much a customer is worth over the lifetime of being a customer with you, how much gross profit is going to be generated after your revenue minus your cost of goods sold, and you have your gross profit times the lifetime of that customer, what a customer is worth. Customer acquisition cost is going to show you how much it costs to get that money, right? And the name of the game is to make sure that your customer acquisition cost is less than your lifetime gross profit, right? You want to make sure that you're acquiring customers profitably. First step is to make sure that your CAC, right, customer acquisition cost, is less than the lifetime gross profit. If it's not, then you're spending more money to get a customer than they're generating for you. And that's a great way to go out of business, right? If it's greater than your lifetime gross profit margin, then the very next thing that you want to figure out is your gross profit in general, or how much time it takes to recoup your CAC from the gross profit, right? And that's gonna show you your payback period. We'll get into that in a second. Customer acquisition cost, though, it's total sales and marketing expenditures. So you're figuring out not just how much, common mistake here is how much money are we investing in ads, for example, if that's how we're getting leads. It's not just what you're spending in terms of marketing costs. It's your total cost of marketing and sales. It's everything that's bundled together to deliver a net new customer to your business system. You're taking that, you're summing it up, and then you're dividing it out by the number of new customers that come in within that period. So on a monthly basis, a great way to do this, we benchmark it usually on a weekly basis, and then we sum it up on a monthly basis, we reconcile, and then we do everything again on a quarterly basis, just to make sure that we're trending in the right direction and we're benchmarking appropriately. But on a let's use an example of a monthly basis, you're going to take all of your marketing expenditures, all of your sales costs, all of your sales expenditures, you're going to sum those together, and then you're going to divide that number out by the number of customers that came in that month. That's going to get you your CAC. CAC is an extremely valuable number to know because it's a starting point to be able to plan from, right? What we want to figure out is our lifetime gross profit to CAC ratio. And this is going to show us the overall profitability of our business system, right? This is going to give us a pulse. And there's some, simple benchmarks to use to help us determine if we have a healthy business that's profitable, or if we have a business that's less viable than would be ideal, and there's work to be done. So by knowing this ratio, we can make good timely decisions, and then we can lever up or we can lever down or focus in the right places to improve our business over time. So the LTG to LTGP, lifetime gross profit, to CAC, customer acquisition cost, is ultimately the return on investment for acquiring a customer over the lifetime of that customer. And the target here, traditional target, standard target, again, always variance asterisk, based on your industry or business, it could be, different. But 3 to 1 is a really healthy business that if it's 3 to 1, three times LTGP to the CAC in terms of a ratio, that means that there's enough margin to be able to support some scale to that business if the business can scale, right? And if it's less than that, it's going to become a little bit too cash constrained to be able to support ongoing, scale and sustainability and growth of the business, right? So 3 to 1 is kind of a standard known number for a healthy ratio to be able to try to achieve here. Then you have your payback period. And you can think about payback period on a lot of different things, right? So you could use payback period in terms of, an investment that you're making, right? Maybe you're acquiring a business and you put money down and you want to figure out the initial cash investment that you made to how much, profit you're putting in your pocket. And that's getting you a payback period of how much time it takes to get paid back. You could equally do it for your CAC, right? So, previously we just talked about lifetime gross profit, but on each unit, there's unit economics to your business, and each unit has a gross profit. And every sale you make has a gross profit tied to a customer. What I like to figure out is what my customer acquisition cost is and what my payback period is per customer, per unit basis. So you're trying to figure out the required investment of acquiring a customer in the CAC scenario, but really payback could be use any investment, and then how much time it takes you to make that money back off your margins. It's going to show you how much risk is associated with the decision you're making. So again, if I have a customer acquisition cost of 100, or let's say 120, and I'm making a $10 gross margin per sale, then I need that customer to purchase 12 times before I'm getting paid back, right? So that's maybe a little bit risky, because what's the chance of them stopping being a customer? That's when we go to our lifetime, our lifetime gross profit. We see how long a customer is staying with us, what our retention rate is. We're going to figure out retention based off of churn, which we're about to get into. And you can figure out, whether or not we're in a healthy split position or not, right? Another scenario would be it's a customer acquisition cost of 120, and we're making on a gross profit basis $240 per sale, right? In that situation, it's a one sale payback. And not only is it a one sale payback, but we're at a 2 to 1 ratio in that first sale. That's a very healthy place to be, right? So we want to know what our payback is. We're figuring out our payback because we understand our other metrics that we've already discussed. And it's helping us make less risky decisions in terms of our business. As we're figuring out our pipeline and our sales pipeline, and we're figuring out our costs, and we're figuring out our lifetime, our lifetime gross profit of our business, part of figuring out the sales component is the velocity of sales, right? I want to know how effective my sales process is, how efficient and effective my sales process is, by helping me understand, how quickly sales are taking place inside of my business, right? Because if we have a very long sales process, if the sales cycle is a long cycle and we're not closing enough opportunity, then we're not going to be bringing enough money into the business to be able to sustain the business from an operational perspective. So we want to know what our sales velocity is, which is going to be the number of opportunities times the average deal size times the win rate, right? So that's going to get us what our pipeline value is, right? That's the deals closed, number of opportunities, how many opportunities, what is the value of those opportunities, what is our win rate, right? That's going to show us how much business we're closing divided by the amount of time it takes to close. That's going to show us how fast revenue flows through our business system, which is going to help us with forecasting and making good timely decisions as we're building out our quotas and targets, right? So we could, be able to, appropriately manage our numbers. Once you know your sales velocity, the next thing that I'm kind of curious of which is sales velocity is acquisition of customers. The next thing I'm curious of is retention of customers. Opposite of retention is churn. So churn is ultimately the number of customers or percentage of customers that are leaving your company. If you don't have any churn, then your lifetime gross profit is going to go through the roof because you're going to continually have customers repeat buying from you, right? That would be an amazing problem to have. But the reality is, in real life, most customers are eventually going to leave you, right? They're going to maybe go out of business themselves. Maybe another competitor comes in that poaches them away. Maybe markets change and they no longer need the solution that you have, right? So for various reasons, customers tend to leave you. The name of the game here is to figure out at what rate a customer is leaving us. Because if we know what rate they're leaving us, that's a simple way for us to then figure out the lifetime customer value, because we can take our churn rate and then factor in how long a customer will stay, right? The inverse of churn is retention, right? Also inclusive in that, we could figure out what our sales velocity targets need to be, because we want to always be acquiring more customers than we're losing, right? High churn means typically there's improvement to be made inside the business, right? Low churn means typically, you're delivering a valuable solution and, customers are happy and they're continuing to display that happiness through retention, right? So churn is a really important metric to pay attention to, both to factor out and calculate other things, as well as for an indicator of health of the business, right? Once you know your sales velocity and you know your churn, this is how you're going to get your velocity to churn ratio, right? Which is ultimately going to show you the effectiveness of sustaining positive sales, net positive sales, right? It's the metric that's going to show you the difference between acquiring customers versus losing customers. And the name of the game is to usually have more customers in your portfolio so that you're growing your customer base, over time. So understanding both of those are going to help you make good timely decisions when it comes time to determining whether or not there's things that need to be improved, maybe in customer support, customer retention, reassessing of the product, the value, the positioning, are we selling into the right value propositions? Right? Are we delivering into the value propositions in which we sell? Are we supporting the adoption and utilization, the path to utilization for stickiness? Right? Are we maintaining relationships and building trust and rapport for repeat purchase? Right? So all of these things typically will come down to brand equity conversations when you're looking at your business and you're trying to make good timely decisions of how to pull certain levers. When we're talking about our sales pipeline now and our sales process, because that's what these metrics are leading into, right? We're figuring out ultimately now what we need to run in terms of metrics of our pipeline to achieve the targets inside of our financial profit-led financials of our business. Gross meeting to close is the total number of meetings that are booked versus the total to the number of closes or wins or successful sales that are made. Many times you'll see teams talking about, I believe what's going to be the next thing, which is net meetings to close. We really kind of support the concept of sales teams focusing on gross meetings to close as the ratio, which is, again, number of closed deals divided by the total number of initial meetings times 100. And the reason why we want to focus here as opposed to net meetings is there's a no-show rate. And by focusing on the gross meetings as a key leading indicator with your sales team, you can hold accountability to that no-show rate. Because a lot of sales folks are like, my close ratio of somebody who shows up to a meeting to then my close is through the roof. But if no shows is really high, then you could put accountability on that sales rep or that, person who's responsible for closing the business to say, what are you doing between steps, right? How are you getting more folks to show up to more meetings? How are you getting more meetings on the book? And a lot of the times folks will try to get away from this gross number and they'll try to pass it on to like marketing or some other component of the business. And they'll just try to keep accountability to like what they've done and delivered. We highly suggest you kind of, look at the whole picture, because it's all about structure, strategies, and accountability. And this will help you put more accountability on your sales folks to make sure that more meetings are shown up to, which then gets us to our no-show rate, right? Because, it costs us money to book those meetings. It's all tied back to our cost, our CAC, right? We want more people to show up to meetings. There's a natural no-show rate, which is the number of no-shows or people that don't show up divided by the total number of meetings scheduled times 100. A high no-show rate means you're not positioning good intentional value from the initial message to a meeting to book that meeting versus, the execution of the intention of somebody being interested in showing up, right? So that could be maybe the folks that are booking meetings for you aren't using great messaging. There's low intention based messaging. There's not really a sense of value that's being positioned, right? Another reason could be your lead magnets. Maybe you're using the wrong types of lead magnets and there's better, again, positioning of value. Maybe your lead magnets aren't incentivizing people to show up to meetings. Maybe there's in-between steps that are being missed. Maybe you don't have automation set up for reminders. Maybe you're not, incentivizing your sales reps to follow up to make sure meetings are shown up to. Maybe you're not providing any pre-work to get some buy-in or skin in the game prior to the meeting, right? There's different things that you can do to increase or realistically decrease your no-show rate. And the name of the game is to get it down to 0, right? But something like 10 to 20%, that's kind of, a known type of factor that you then build into your pipeline when you're forecasting, right? That then brings you to your net meetings to close ratio. This is what ultimately most reps will benchmark themselves off of. This is how many calls I actually had. This is how many people I actually got to pitch. And this is how many wins I generated off of that. It's an important metric because it's showing you the quality of your sales process or your sales approach, your pitch, right? So how you're winning business. And it's showing you whether or not maybe your scripting is wrong or right, or positioning is wrong or right. And if you have enough reps, right, it shows you law of large numbers, who's performing versus who's not. So why you want to pay attention to this stuff, but again, don't necessarily let this be the end all be all, because there's those in-betweens of the no-shows and the gross, which you're paying for every meeting. So you want to maximize in terms of velocity of CAC. The last couple of metrics here, right, are getting outside of sales and now into more of like the general business health. First one's debt to cash coverage. Debt to cash coverage is the total debt divided by the available cash. And it's an indicator of your ability to service your existing outstanding debt, right? So if the ratio is lower, then that's going to suggest that the business is in a position to be able to pay off debt based off of existing cash. If it's not, then it's going to say maybe it's a little bit over levered. And it's an indicator of the overall financial health of the business and the ability to manage cash flow, right? And the ability to ultimately manage all of the rest of these metrics that we went through today, which all ultimately impact, your profit in your pocket, right? The last thing that we're going to focus on is, optimize for people. And what I love seeing benchmark lately, and this is realistically since like end of ZERP era and into this new, profit-led era where we're trying to optimize for profitability of businesses. Previously, folks didn't necessarily care as much about revenue per employee. If you bootstrap a business if you've been in the school of bootstrapping businesses or building profit-led businesses or simple profitable businesses, you've kind of always cared about this. But this is now one of these metrics that's being reported across the board, venture-backed or not. And for some of the businesses out there that have been able to really achieve some amazing numbers in terms of the amount of revenue generated per employee, it's showing the overall capital efficiency, the cost efficiency of the team, right? Of the human capital. And the goal here is to be able to get this number to be very appealing, where the amount of revenue that's being generated per employee on your team is as high as possible. And that's just showing a very efficient and effective business. So you're taking the total expenses and you're dividing it out by the number of employees. That's the expense per employee. Revenue per employee is the total revenue divided by the number of employees. And both of them are indicators in terms of the overall healthiness from a per headcount basis when you're budgeting. Right. So sometimes on the expense side, it's showing if, maybe we're investing too much in things on the employee basis. That also can include what we're investing in to support the employee to be able to achieve their outcomes. And then from a revenue per employee basis, if we understand what the costs are, right, then we want our revenue per employee to be even higher. And then you could take another. So right now I just separated this into 2 slides. I only have revenue per, but then I also put expense on the description. So that's the why behind that. But what I'm also realizing is I could easily add a slide 16, a slide 17, a slide 18, because you could do gross profit per employee, right? So now you could have an indicator of your gross profit per employee headcount. Right. And what you're trying to ultimately, you can also do your net income, your net profit per employee, your profit in your pocket per employee. And each of these is going to indicate how effective you are in terms of budgeting on an employee basis from a cost perspective as well as a production perspective. And I think it's a really important underutilized metric that helps you really focus in and make good, timely decisions from a sense of people. And at the end of the day, great people make great companies, right? And sometimes it's not just about how you can cut costs. It's also about how you can make investments, strategic investments in your people. And because you're making these strategic investments in your people, you could see the uplift as a byproduct. And that uplift would be something like the increase of revenue or gross profit or net profit per employee. That being said, if you are doing these things today, that's awesome. If you're not and you would like to, or even if you are and you want to maybe get a little bit more accountable, we have this template that we've put together. It's something that we actually use in our business. It's what we use for our portfolio companies or for our subsidiary companies over at Simple Holdings. It's also what Simple Profits uses, which is our business advisory firm, for all of their clients. And it's really simple. You can track it on a weekly basis. We manually put it in. We try to really promote, remove automations and make a lot of these things manual in terms of tracking and reporting, because it's just that extra step that forces you to try to, get some additional line of sight accountability. Sometimes when things are automated, we don't really appreciate it the same, but when we're forced to put it in, we're forced to look at it. It's like writing it down, read it, write it, absorb it type of thing. We usually run ours on a weekly cadence. Not all these numbers, not all these metrics are tracked in the same cadence, but then we, have targets and actuals, and we'll keep track of our status, right? So we'll have this is red zone. We need to take action upon this. Red flag. Yellow is, maybe this is something that we should pay attention to. Green, things are good. And you kind of want to know that. You want to know who owns the metric in the business. You want to know where they're being sourced from so that you can keep it simple. And then any sort of retrospective notes. This stuff is just on the metric side. And then typically the metrics that matter help make decisions, help you make good, timely decisions when it comes time to measure what matters and, ultimately making larger strategic decisions across the business. This becomes kind of a really healthy dashboard use for an owner of a company, right? Say you're at, exit stage 3, exit stage 4, you've now hired an operator. maybe your operators are running the measure what matters component in your business, and you just want to make sure everything's healthy as a passive owner, you're going to want to really, pay attention to these metrics and to make sure all the metrics are healthy. It's like one of the key leading, dashboards for an owner of a business, let alone, an operator. If you want to, check out ours, we do our own build in public over in the community, over at Bootstrapper community. I think we're like getting close to 600 or 700 members at this point, which is pretty cool. We have our newsletter too, which has around 50,000. And then all of the digital templates, they're available over at shop.bootstrapper Capital. You can use promo code Bootstrapper and get access to that. Until next time, trust the process, commit to the journey.